Hello everyone, welcome to my YouTube channel. My name is Mubashir and you are watching my official YouTube channel Investology.com. Today we will be discussing 7 basic terminologies of stock market. These terminologies are very basic for an individual, for an investor. If you are new to the investing world, trading world, then these terminologies can be handy for everyone. Let's see what all terminologies we have. The first terminology is buy. It means to buy shares or to take position in a company. When you purchase a share of a particular company, this means buy. Moving on. Second term is sell, getting out of a position or sell the shares that one had purchased. Generally, shareholders sell for two main reasons. One for profit booking and the another one is cut losses. When you have a substantial amount of profit from your from your trade, you go for the selling, or if you purchase any stock and that turns out to be a wrong stock, then you sell stock for to cut your losses. Next term is bid. It is the highest amount of money a trader or an investor is willing to pay per share for a given stock. Next term is ask, the price that people seek when selling their shares, how much it will cost you to buy a share of any company. Next term is spread. It's simply the difference between the bid and the ask price of a stock, or the amount for which someone is willing to buy or sell. For instance, if a trader is willing to trade ABC stock for rupees, let's say 10, and a buyer is willing to pay rupees 9 for the same stock, then the spread is rupees 1, which means 10 minus 9, it will be 1. Next term in the list is bull market. It's basically a market condition where stock prices are expected to rise. A bull market is categorized by optimism, high expectation, and a high level of investor confidence in general. Here, buyers are more than sellers. The commonly accepted definition of a bull market is when stock prices rise by at least 20%, only then the condition can be called as a bull market. Otherwise, it can be a normal general rise in prices. When it comes to the stock is going up, the stock is running high, but at least if it is not beyond 10-20%, then it cannot be considered as a bull market. The next term that we have is, so next term is bear market. This is opposite of a bull market and full of pessimism and low investor expectation. In bear market, investors expect stock prices to fall. There is no specific criteria for a market to be classified as a bear market. However, decline of around 20% in the value is often considered to be a common feature of a bear market. Here, sellers are more than buyers. Bear markets can be cyclical or long term. The former lasts for several weeks or a couple of months, and the latter can be last for several years or even decades. So bear market is a condition where the stocks prices fall continuously, and at least 20% prices in almost every stock which is index falls on a daily basis. When this happens to any particular stocks, or in general stocks, then this condition can be called as a bear market.